You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. We're digging into some pretty dense but really critical global briefings today. We've got insights on foreign exchange, commodities, trade, and of course the geopolitics driving it all. Our goal here is to connect the dots for you, finding the crucial links in all this complex information.
Exactly. And, the main thread tying all this together, it's how closely financial flows are now linked to policy moves, political risks, and frankly, some very hard deadlines. We're seeing central bank talk move currencies one minute, and then actual military action spiking commodity prices the next. It's this mix of finance and politics that's really defining things.
Okay, let's jump right in. Starting with foreign exchange, always a big one. Central banks seem to be walking a very fine line. The dollar, it started the week a bit softer.
Yeah, it did. The DXY index pulled back a little after hitting 97.82. Not a huge move, but significant.
So what's behind that? Just a bit of profit-taking or something more?
Well, I think it signals a little bit of market doubt, maybe. Skepticism about the Fed's narrative, perhaps. It suggests traders aren't fully buying into more aggressive heights right now. And, that risk appetite then sort of spills over into other currencies.
Like the euro. Euro USD managed to climb back above 1.1750. Is that just dollar weakness, or is something happening specifically in the Eurozone?
It's a bit of both, really. The dollar softness helps, but there's also this interesting divergence within the European Central Bank itself. You've got quite different signals coming out.
Ah, right. I saw Martin's Kazaks was quoted saying they'll have plenty of data by December. Sounds like patience.
Exactly, patience from Kazaks. But then, almost in the same breath, you hear Jeremy and Šimkus arguing that a December rate cut is needed.
Wow. Okay. So one saying, wait, the other saying cut now? That's not exactly a unified front.
Not at all. And that kind of public disagreement, well, it creates uncertainty, makes the market hesitate. Volatility is pretty much guaranteed when your central bankers are sending opposite signals.
Meanwhile, back in the U.S., the Fed seems to be trying to project calm, right? Governor Miran saying, we are in an easing cycle.
Yeah, and Mary Daly over the San Francisco Fed noting the job market has softened quite a bit. They're definitely trying to manage expectations, maybe talk the dollar down gently.
But are the markets really convinced by this dovish talk, given how quickly the DXY reacted earlier?
Maybe not entirely convinced, but they are reacting to the intent. They hear the dovish signals, but it's fragile. I mean, if we get strong job numbers next week, all that talk could evaporate pretty quickly. It shows how sensitive things are right now.
Okay, but you mentioned the currency story with the real political drama right now is the yen.
Oh, absolutely. USDJPY pushing up towards 148, highest since early September. And this isn't really about the Bank of Japan this time.
It's the LDP leadership race, isn't it?
Exactly. All eyes are on the politicians in the Liberal Democratic Party, specifically their willingness to potentially spend big. You have Takaichi, who's polling pretty well, around 28%, openly talking about cutting the sales tax on food.
Which signals more stimulus.
A big signal, yeah. It tells the market that fiscal discipline might take a back seat to boosting the economy. And that tends to weaken the yen, think higher inflation down the line, maybe more government debt.
And before we move off currencies, we absolutely have to touch on that ticking clock in Washington, the September 30th deadline for government funding.
Right. Critical deadline looming.
But the House isn't even scheduled to be back until October 7th. How does that work?
Well, it doesn't work smoothly, that's for sure.
Yeah.
And this isn't just a U.S. domestic issue. It creates global uncertainty. Markets hate this kind of brinkmanship. Having the U.S. government potentially shut down because the legislature isn't even there to negotiate, it just adds this layer of structural instability right under everything else. That uncertainty definitely impacts the dollar and treasury markets.
Yeah, you can see how that political risk feeds directly into market anxiety. Which brings us neatly to commodities. Because when politics gets messy, or diplomacy fails, commodities often react first.
That's right. Physical assets, real-world impacts.
Crude oil, for instance. WTI was hovering around, 62 to 63 degrees per barrel? It saw a bit of a geopolitical bid, but the weekend seemed particularly volatile.
Immense volatility, and driven by really specific events. Three main things jump out.
Okay, what were they?
First, you've got Washington pushing hard for Europe to just stop buying Russian oil altogether. That keeps the supply pressure on.
Right, the diplomatic angle.
Second, the kinetic stuff. Reports of Ukrainian drone strikes hitting oil pumping stations. These were linked to the Novorossiysk export route, which is a major one, so that's a direct threat to actual barrels flowing.
A physical disruption. And the third driver, you mentioned it ties back to geopolitics.
Yes, the incident in Eastern Europe. Estonia triggering NATO Article 4 consultations after those Russian jets entered its airspace near Vainlu Island.
We'll come back to the Article 4 details later, but how does that specific event impact oil right now?
Well, it might not stop oil flowing today, but it dramatically increases the risk premium for everything in that region. A NATO member formally calling for consultations over a Russian military action. That ramps up tensions significantly. So you have diplomatic pressure, physical disruption risk, and a major geopolitical flashpoint all hitting at once. That's a recipe for oil volatility.
Given all that instability, it's maybe not surprising then that precious metals are doing so well. Gold, especially.
Well, gold is the standout. Absolutely flying, benefiting massively from this risk-off mood. It hit on another record high. Was it USD 3,726 an ounce?
3,726, a new record. What does that really tell us beyond just being a big number? What's the underlying message from the market?
It tells us investors are pricing in something more than just short-term jitters. A record high like this suggests a deeper concern about long-term political stability, maybe a lack of faith in fiat currencies holding their value over time. It's capital looking for a safe haven, not just from the next news cycle, but from potentially ongoing structural geopolitical risks. Things like the war in Ukraine, tensions in Asia, the sense that these aren't just temporary problems.
Okay, so gold is the safety play. But what's interesting is that copper, which we usually think of as reflecting industrial health growth expectations, that also pushed back above $10,000 a ton.
Yeah, above the USD 10K handle. That's notable.
So why are both safety assets and growth-linked commodities rising at the same time? Seems a bit contradictory.
It does, but it's driven by a very specific mix of factors squeezing the supply side for copper. There's not necessarily a booming global demand right now.
Supply constraints. What's happening there?
Two key things. On the micro level, you've got Codelco in Chile, they're a huge producer, announcing that one of their major mines is going to take longer than expected to get back to full production after that tunnel collapse they had back in July.
Okay, so less Chilean copper hitting the market.
Right. Less supply, price goes up, simple mechanics. And then there's the macro factor, which is coming out of China.
Beijing. What are they doing?
Beijing has pledged to tighten controls on steel capacity and actually ban new steel projects. This is part of their broader push to manage industrial output, maybe shift towards greener production.
How does restricting steel affect copper prices?
Well, the immediate market interpretation seems to be that while overall volume might eventually be managed, the materials needed for China's new, perhaps higher spec or greener, industrial focus will be in high demand. It keeps the market tight for key inputs like copper, even if overall growth isn't necessarily accelerating wildly.
Interesting. So specific supply issues are key there. Let's shift gears to trade and tariffs, specifically the U.S.-China relationship. Lots of complex signals here.
Very complex. A real push-pull dynamic.
On one hand, we see attempts at stabilization. That U.S. House delegation visiting China the first since, 2019? That's significant.
It is a clear signal of wanting dialogue. And you had the U.S. president making positive comments, even mentioning TikTok, saying nothing bad will be allowed to happen to the app. Trying to smooth things over on the tech front, it seems.
So signs of a thaw. But then there are these other actions that seem to go in the opposite direction.
Exactly. That's where it gets tricky. While you have this diplomatic outreach, reports also surface suggesting the U.S. actually held back approval for over $400 million in military aid to Taiwan earlier this summer.
Wow. Okay. Withholding aid to Taiwan while trying to improve ties with Beijing, how do you square that?
That is the million-dollar question, isn't it? Or the $400 million question, I guess. It strongly suggests a strategy of trying to compartmentalize. Separate economic talks from security issues. Perhaps using the timing or approval of that Taiwan aid as a kind of unspoken bargaining chip in discussions with China, offering an economic opening while maybe holding back slightly on the security front as a negotiating tactic.
That sounds like walking a very dangerous tightrope.
extremely high stakes, trying to manage cooperation and confrontation simultaneously. It's a real geopolitical minefield they're navigating.
Okay, sticking with policy, but moving away from U.S.-China for a moment, the briefing highlighted two other policy nuggets that really jumped out at me. First, something brewing in the EU regarding big tech.
Yes, this is potentially huge. The report suggests the EU is getting ready to block major tech companies, likely U.S. ones, from participating in a new financial data sharing system they're setting up.
Block them completely. What's the impact of that?
It's effectively building a new regulatory wall around European financial data. It makes it much harder and potentially more expensive for global tech firms to offer integrated financial services in Europe. It looks like a move towards digital regionalization, maybe even a form of digital protectionism, framed as data regulation.
Okay, that's one to watch. And the second policy nugget you mentioned, this one sounds like it could have immediate massive impacts on businesses in the U.S., especially tech.
Oh, absolutely. This concerns H-1B visas, the ones used for high-skilled foreign workers. The administration is reportedly planning to add a huge new fee.
How huge?
We're talking USD 100,000
Per visa.
per year.
Wait, $100,000 per year for each H-1B employee.
That's the number being reported, yes. The Commerce Secretary apparently framed it just like that firms will essentially pay $100K per year for these visas.
That's astronomical. That fundamentally changes the economics of hiring foreign talent, doesn't it?
Completely. For any company relying on H-1B workers, especially in tech, where they hire many engineers this way, the cost calculation just exploded. It could force companies to rethink hiring, maybe move jobs elsewhere, or drastically cut back on using the H-1B program. It's a potential earthquake for talent acquisition in the U.S.
Huge implications indeed. Okay, let's broaden out again for our final segment, a quick run through some key global geopolitical flashpoints, starting back in Europe with Estonia.
Right, as we touched on with oil prices, Estonia formally requested Article 4 consultations with NATO.
Remind us, Article 4 isn't Article 5, the Mutual Defense Clause, right?
Correct. Article 4 is triggered when a member state feels its security or independence is threatened. It requires the North Atlantic Council, all the NATO ambassadors, to convene and discuss the situation. In this case, it was triggered by that 12-minute airspace incursion by Russian MiG-31s. The fact that a relatively brief incident leads to a formal NAC meeting really underlines how high tensions are. It escalates the situation diplomatically and potentially militarily.
Okay, over to the Middle East. The ground seems to be shifting there regarding the Israeli-Palestinian conflict.
Quite dramatically. We saw the UK, Canada, Portugal, and Australia all move to recognize Palestinian statehood.
That's a significant block of countries. How has Israel responded?
Predictably, with strong rejection. They categorically reject unilateral recognition. And there are reports they're now considering possibly full or partial annexation of the West Bank as a direct response.
Annexation. That would be a major escalation.
A huge escalation. And this is all happening just as the U.S. president is scheduled to meet with Arab leaders, presumably to try and calm things down. So it puts enormous pressure on those diplomatic efforts.
And finally, let's look at Asia, specifically the Korean Peninsula. Tensions seem high there, too.
They do. South Korea's president explicitly warned about the threat posed by military cooperation between Russia and North Korea.
And North Korea's reaction? Any sign of wanting to talk?
Quite the opposite. Total rejection of talks under current conditions. North Korea's leader was quoted saying the very idea of denuclearization is no longer valid.
No longer valid. That's
It's a profound shift. It essentially signals that North Korea sees itself as a nuclear state, period, and isn't interested in negotiating that away. Decades of diplomatic framework seem to be dissolving there.
And just to complete the picture, the briefing also mentioned continued U.S. kinetic actions elsewhere.
Yes, a brief note that the president confirmed ordering a lethal kinetic strike against a suspected narcotics trafficking vessel in international waters under U.S. Southern Command, resulting in 3 reported fatalities. It just underscores the sheer range of challenges from high-level diplomacy and trade talks to active military engagements happening simultaneously across the globe.
So, pulling all these threads together, what's the core takeaway for you, the listener, trying to make sense of all this?
I think the single biggest theme is this convergence. The convergence of politics, policy uncertainty, and hard deadlines directly impacting financial markets. You can't look at the dollar or oil or gold in isolation anymore.
Every move seems framed by these non-economic factors right now.
Exactly. And look, this isn't likely to ease up soon. This week is packed with more central bank speakers, more potential political developments. Today's briefing, this deep dive, it's really just capturing a snapshot of ongoing pressure.
Indeed. And think about this as we wrap up. We talked about that September 30th U.S. government funding deadline, with lawmakers potentially not even being in Washington. Now, consider what happens if that deadline hits, causing potential financial disruption. At the exact same time, NATO is formally meeting under Article 4 to discuss a military incident involving Russia. What happens when those financial and political clocks both hit zero simultaneously? That convergence of risk? That's something you'll definitely want to crack closely this week.
Definitely one to watch. Until next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.